Welcome to this week's Real Estate Q&A, where I discuss 5 top questions and comments from viewers throughout the last week. I'll start with saying that the housing market is showing more signs of stress, with mortgage rates hitting 23-year highs, causing buyer demand to drop off to levels we haven't seen since the 1980s recession. And now mortgage investors are scrutinizing borrowers more than we've seen since the 2008 Great Financial Crisis, and this, guys, is due to rising mortgage delinquencies and defaults. And quite honestly, I'm starting to hear from lenders that there's been a lot of fraud in mortgage applications, and now it may come back to bite these lenders in the you-know-what. Guys, thanks so much for watching this video. If this is your first time watching, I'm Todd Sachs. I'm a real estate broker here in Maryland, and we're going to discuss some of the things that are happening in this crazy housing market. So everything is good when someone buys a home and can pay their mortgage, but the minute that they start to fall behind in payments, stop paying it, or go into some type of mortgage forbearance like we've seen in the last 3 years, when they first got their loan, what happened was the originator probably sold their mortgage to what's called the secondary mortgage market. And that's where investors actually pay lenders a commission to essentially buy that loan. And the way that that investor makes their money is really on the long term, as people pay for their mortgage every single month over the term of, let's just say, 30 years. So what happens when people start defaulting on their mortgage? The investor actually pulls out all of the original documentation when the loan was underwritten, and they start to scrutinize the underwriting process. They start to look at the appraisal. They start to look at the paperwork, whether these people really should have qualified for the mortgage in the first place, or whether there was any type of fraud. And what happens is they can require the loan originator to actually buy back the mortgage, and that can put these mortgage lenders in a really tough spot, as they are looking at their operation right now as not being profitable, as we are now looking at lower demands for mortgages that we haven't seen since like the 1980s recession. So now the lenders don't have any money originating loans. Now they're being required to buy back the loan that they sold to the investor on the secondary market, and they're actually penalized for doing so. There's a penalty fee that comes into play. They have to pay back all of their profit that they made when they originated the loan, and they're stuck, right? So now they're not in a position to buy these mortgages back. Then what has to happen is they have to find out who can buy these loans at even deeper discounts to get them off their books. So let's take a look at a recent article that was published on housingwire.com. All right, I'd like to drop this article in the show notes, but unfortunately, I have a paid subscription, so that's the only reason that we can take a look at it here today. But this is titled here, Fannie and Freddie Face Dilemma in Loan Repurchases. And what they're referring to here with loan repurchases is exactly what I'm talking about, right? The loans were sold, and now they're being repurchased because of default. It says that credit risk goals may be sparking increase in loan repurchase rates. Now, we know that the government is trying to push homeownership. And we also know that by doing so, they lower the requirements for someone to be able to get into the house, like 0% down with low down payments and first-time buyer grant programs, and reducing the requirement for credit scores and things like that. Riskier borrowers is what they're referring to. It says the concern is mounting among housing industry experts that loan repurchase rates in upcoming quarters are likely to continue to trend upward for independent mortgage banks, IMBs, well above historical rates. It also says that what feels more painful now is we're not seeing a rapid downward trend in repurchases, even though we've seen a pretty marked reduction in total originations. Let's kind of dissect this. We're not seeing a rapid downward trend in repurchases. That means that it is going higher, right? It's not a downward trend. It's a rising trend, that these lenders are taking these loans back, even though we've seen a pretty marked reduction in total originations. That means these lenders are less profitable because they're not making money on the loan originations. This is causing a concern in the housing market because a lot of these lenders are going to go bust. So let's kind of take a look at, what is a defaulting mortgage? So mortgage loans are kind of broken down into two different types, right? There's performing and non-performing, and then there's something called a scratch and dent loan. So let's just kind of dive in here. The most common classifications of mortgage notes for investors are performing or non-performing, also known as NPLs. Performing loans have met all of their compliance criteria, have been paid on time, and are sold at the highest premiums. This is kind of like where the investor says, hey, I have extra money, but I don't really want to be in a risky situation. We've got good borrowers. They're paying their mortgages. Hey, we'll pay a premium for that. These are the types of investors that maybe don't want the actual asset like the house. Non-performing loans are not performing as they should. Borrowers are late on payments or are in some stage of default. That doesn't mean that they cannot be resurrected. Yet in this state, they are sold at deepest discounts and in turn can often prove to be among the most profitable. Okay, we're going to get back to that. But let's talk about the scratch and dent loans. This is another classification of mortgage notes that is often overlooked. These may be underperforming loans, reperforming loans, or have minor flaws. In turn, these notes are typically sold at discounts, not as deep as the non-performing loan. Now, let's just talk about a scenario because a lot of people want to say like, can I buy or get a deep discount when the bank actually repossesses the property through foreclosure, puts it on the market, and, can I take advantage of getting a good deal this way? And a lot of the answer with that is no. Because the banks want as much profit as they can when they take the property back. The investors that make the big money in the real estate industry are when they actually buy the defaulting loans or these scratch and dent or even at bigger profits when they take the higher risk of a non-performing loan. And let me give you an example on that. Let's just say that Joe and Sue borrower, home buyer, they take out a $500,000 mortgage. And that mortgage is then after origination sold to the secondary investor. And they say, well, that's a performing loan. We'll pay for that. We'll give you a premium because, hey, it's a new loan and you approved them, so let's give them a try. When they realize that they're non-performing or scratch and dent, something's happened where they start falling behind or they, worst case scenario, non-performing loan, they're in default, then what happens is the lender, in some cases, has to buy that loan back, right? Well, what do they do with it? They don't want the loan. They don't want the house. They have to, in turn, resell that loan to an investor that says, hey, I'll buy it, but I'll give you 40 cents on a dollar or 50 cents on a dollar. Right now, they're saying that the average for scratch and dent is about 68 to 78 cents on the dollar for the actual loan amount. Or when you get into non-performing, you could see deep discounts of like 40% or less, where an investor can actually buy that $500,000 mortgage at 40% of its value. These types of investors are the ones that back in the great financial crisis actually stole these houses, right? It was not literally stolen, but you know what I'm talking about. They ponied up millions of dollars, sometimes hundreds of millions of dollars, buying these houses for nickels on a dollar. And guess what? If they were loans where people were not foreclosed on yet, they would be happy to foreclose on these people because they get their house for a deep discount. So this is really, in my opinion, what these institutional investors are like sitting back licking their chops for right now is they can't wait for these defaults to happen and they can come in and scarf up even more of the single family inventory that's out there right now for nickels and dimes on a dollar. All right, so let's talk for a minute about how some of these defaults are happening in the first place. Well, a big thing right now is that COVID money is about to run out. So that's happening in November. We're going to see where a lot of these forbearance programs are ending. If they haven't gotten it right by now, I mean, the can's been kicked down the road so much that it's not even a can anymore. And so these people, unfortunately, a lot of them are going to lose their house or their loans are just going to be sold out from underneath of them to investors that will hope to kick them out. And then we're not even really looking at the occupancy fraud that we've experienced over the last 10 or 15 years. And these are borrowers that have gotten a residential loan that had no intentions on living in the house in the first place. When money was cheap, they bought these second houses. They were hoping to rent them out. They're now becoming not profitable with rising costs, and these people are defaulting on the loan. And the question is, will these investors go after the loan originators or the owners themselves, the home buyers themselves, with fraud cases saying, you know what, we didn't underwrite this mortgage properly because you bought it as an investment property and said you were going to live in it. And now that you're not paying your bill, remember I said everything's okay until they stop paying. Now they're not paying their mortgage and they're going, wait a minute, you never lived in this house. We wouldn't have given you this loan because you wouldn't have qualified the same. You would have had to put down 25%, 30% down instead of 3%, right? So, I mean, this, guys, is what we're talking about as a big mess that's going on right now. And I want to bring our attention to this next article from investorplace.com. Now, guys, I tell you what, many people saw this financial crisis coming from a mile away. Many people like myself even saw the housing market starting to turn like a year and a half ago when people were saying, ain't happening, never will, prices will never go down, blah, blah, blah. Well, let's take a look at this. Housing market crash. Moody's warns of a ticking time bomb. Now, guys, this article was written on May 15th, and what they're referring to is that Moody's chief economist, Mark Zandi, spoke to Congress warning them about the importance of avoiding a U.S. debt default. It goes on to say in this article that the housing market has become a focal point of the current debt ceiling. I mean, we certainly know that it makes up a huge amount of the inflation that we've been dealing with, like housing, shelter inflation, right? The rental market and the lack of affordability for homeowners that have overpaid for their house in the last 3 years. But it says some estimate elevated mortgage rates brought on by a default would push sales down as much as 23%. Guys, this is what we're talking about right now today in the article that I just showed you by Housing Wire and what's happening as lenders are buying these defaulting mortgages back. So the article goes on to say that the housing market crash fears swirl as Congress scrambles to raise debt ceiling. Housing remains perhaps the single most rate-sensitive major industry. As such, it would likely experience an accelerated slowdown should the country fail to pay its bills. Hello? Some estimate 30-year fixed mortgage rates could reach as high as 9% in the case of a U.S. default, sending home buying costs up a staggering 22%. Guys, this was in May. They said in this article, this economist said 9% mortgage rates. Hello, we're there. Guys, let's read on. This would kill demand for houses, raise the cost to purchase a home tremendously, lower home values while making them more expensive to finance, and crush home sales, an estimated 23% by September. Giving housing already tenuous state, a default may well be a crushing blow to the industry. So there. All right, so that brings us to our first commenter. Steve Larson says, going to hurt builders and realtors, but a large portion of the population has low fixed rates. And whatever, basically, is what Steven's saying here. He's got a cheap mortgage, and he's only a couple years from paying it off, so let that hit the fan. Well, here's the problem, all right? these low interest rate borrowers are now stuck in their low interest loans. So many of them have used up their home's equity in home equity lines of credit, second mortgages, and these loans typically fluctuate with the higher rates. And also, it doesn't matter how low your rate is, guys. If your home is underwater, meaning you owe more than your home's worth, and you need to bring $50,000 to the settlement table because you want to actually sell your house, you're essentially trapped in your low interest rate mortgage. Now, this is where I believe we'll see the most discrepancy between actually renting and owning a home. As our next commenter says, the big fight is coming. The Fed has insisted that the housing market will need to be reset. The institutional investors are buying every single home and jacking up the price crazily. People cannot compete with those giant corps. Well, you're spot on about some of these things. As I had mentioned earlier in the video, when loans are bundled up and sold for pennies on the dollar, this is how institutional investors win big time. They literally can buy houses for 30 to 50% of the mortgage balance, kick out the owners, and own the asset. And this gets me back to what I mentioned earlier in the video when someone asked, can I buy and get a deal from the bank when they actually repo the house? The problem with that, guys, is the banks actually, in going through the great financial crisis, learned that it would be cheaper for them and more profitable for them to actually go in once they repossess the house, do some minor repairs, paint, put carpeting in, put in a kitchen, what have you, new appliances, and list the home on the market for top dollar. And the home may not be worth what they're asking, but for somebody to come in and offer the bank less money, it's different than actually asking a homeowner for less money, because the banks have a file sitting or many files sitting on their desk. They leave at 4 o'clock in the afternoon. They stop answering the phone. A lot of these people by 2 o'clock, they're off on the weekends. They could care less about making a deal on that house, right? All they want to think about is somebody will eventually buy it and the price is the price. What happens, and most people don't understand, when a bank-owned property hits the market, the only time that the bank really is interested in reducing the price is when the house sits on the market for a long period of time. So unless the buyer offers them within a couple percentage points of what the house is listed for, they just say, no, we can't take that. We're not going to even look at it until the house is on the market 150 days, 180 days, 300 days. Believe me, these banks will hold on to it forever. The big savings is for the Wall Street companies that have 50, 100 million, 150 million dollars to swoop in and buy these loans at discount, like I previously said. So, the real question becomes who is in control of this all, right? Who's in control of the system? How does Wall Street continue to profit on our downturns? And why is it that we put more focus on the investors and helping them become rich instead of actually making affordable housing? Well, I'll tell you who's responsible. It's the corrupt, crooked government. That's who. And that leads us up to our next comment that says the key is to build more homes, housing units, but because the system is so rigged and the interest rates are the be-all, end-all of the housing market, there isn't enough housing units. We have more people than housing units. At the end of the day, that's the main thing that's keeping people out of homes and keeping the homeless. Now, I agree with you on what I think you're saying here. You just may not know all the facts to be saying it correctly, but we are not in a housing shortage, my friend, like the narrative of mainstream media pushes. We are in an affordable housing shortage that is controlled by the government. Agendas blaming protection for spotted owls, the global warming by causing Americans pain, where the rest of the world isn't being held to these expensive restrictive policies, is preventing land development and developer incentives to provide Americans with the affordable homes within the rich neighborhoods. And people cry, we need affordable housing, but not in my neighborhood. What we need, my friend, is leadership in America, ones with the balls to make the decision that don't pad the pockets of those who spend millions to help them get elected. Like these special interest groups. Guys, we better start taking care of ourselves more and watching our spending and not trusting what we hear by these agenda-pushing news channels. Our next commenter says, my husband and I bought a fixer-upper a year ago using the money from the sale of our previous home to fix it up. Would it be great to have a turnkey home? Yeah, but we have been through hard times and didn't want a high mortgage and the struggle to pay. Already with tax increases and insurance increases, our monthly went from $745 to $900. If we bought outside of our means, we would have been in so much trouble by now. I absolutely love this comment. And guys, I think that part of the mainstream media is pushing the narrative that home prices are only going to get more expensive. So you better buy now and refinance later, because people like Barbara Corcoran are saying that home prices are going to go through the roof as soon as the interest rates drop. Barbara, home prices have already gone through the roof. Wake up, smell the coffee, see that Americans are struggling right now. They can't pay their bills. Mortgages are making people feel like they're in prison in their own home because now they have low mortgage interest rates, but they can't afford the house and they hate to lose that low rate. But they don't realize if the home prices drop, they're going to have to bring cash to the table or just walk away from their homes altogether. Now, let's talk, guys, about living within our means. And, like this previous commenter said, what I'm telling people right now, especially first-time buyers, if you bought a house before and you know what the risks are, God bless you. Go do whatever it is that you're going to do. Leave these home buyers alone, these first-time buyers, right? Stop pressuring them. Stop telling them that they're throwing their money away renting. Stop telling them that it's bad that they move back home right now in a time of the least affordable housing that we've seen since World War II, right? If you're going to look for a home right now, guys, don't worry if the kitchen hasn't been updated in 25 or 30 years. Let's go for the deals. Let's be smart and take a look at the house that nobody else wants except investors. And then we offer them a little bit more money than the investor's willing to give them. And then you put your money in the sweat equity. I love this comment. If you want to talk more about the way that I feel you should be strategizing to buy a home, drop me an email. I'd love to talk to you. If you're in Maryland, I'm your guy. I want to serve you. And if you're anywhere else, I want to point you in the right direction to an agent that actually has your best interest. All right. And then Kevin Couture says, shout out to Todd and Melissa for offering real estate education, insight, and professional guests to their subscribers and the general public. Thank you, Kevin. Kevin is a real estate agent in the Tampa, Florida area, and he's a great friend and a trusted referral agent on SachsRealty.com. His link is below in the show notes. And guys, I highlight this comment not to promote Kevin as much as to say that we need to promote truth and liberty in the United States of America. I thank you all for watching my videos and supporting our channel as we try our best at Sachs Realty to help you understand what we see in the market from actual boots on the ground, not pushing agendas as I would actually make more money cheerleading the market and contributing to the lack of affordability in housing that I pray becomes more in reach for Americans sometime in the near future. Lenders are approving now up to 60% of your income to buy a home. This makes me nauseous, guys. So how can you help us spread the word and get some kind of sanity to this market? Guys, you can help us by sharing this video, because the more you share it, the more you like it, the more you comment on the video, it is going to help us with the algorithms to get more views and spread the truth about what's happening, not what you're hearing pushed by mainstream media and special interest groups. Thanks, guys, so much for watching this video. I love your comments and questions. I read them all. You never know. By commenting, you just might be on next week's Real Estate Q&A. And if you haven't subscribed to our channel, please consider doing so now. Smash that alert bell. You'll know every time we upload content just like this. See you next time. Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.